Adrian, thanks so much. It's a real pleasure to be here. I'm really grateful to you and to Quentin and to Magnus for inviting me, and to the Swedish House of Finance for throwing this really wonderful party about central banking and money markets. When I look at the panelists that you've arranged, I can see them in the tableau in front of me. It feels like I'm Daniel thrown into the lion's den. We have all the leading people in money markets, funding markets, repo markets, many of whom I've learned from, and actually many of whom have already commented on this work, with Adam Copeland and David Eland Yang here at Stanford University. So what I want to do is to motivate the topic of the paper, which is that it takes a lot more money, pardon me, central bank money to run the financial system than it used to. And we're going to see evidence of that from US funding markets, focusing on repo markets. This is, I've reoriented the talk a little bit towards making it more of a keynote on the topic area of your conference, rather than focusing so much on the specific case of US repo markets. So it's more about the fact that central bank deposits are much more in demand now than they used to be, largely because of regulatory changes. So I'm going to just jump in. I'm going to do a screen share and motivate this. I'm going to leave enough time for discussion. We have an amazing panel. So, whoops, there we go. So there should be time for discussion. I also need to emphasize that, as usual, the views expressed here do not reflect those necessarily of the Federal Reserve Bank of New York or the Federal Reserve System. I need to say that because we're using confidential data from the Fed. So, how much central bank money does it take to run the financial system? Well, it takes more than the level to which the Fed brought its central bank money down in September 2019. This is what you're seeing on this chart is the Fed's balance sheet normalization program, which started around the end of 2017. The Fed had already announced that it would start to reduce the amount of reserves that are deposited at the Fed by US banks. And I want you to focus in this figure showing US reserve balances during our sample period on the three segments of total reserve balances. The blue segment at the bottom are the reserve balances of the 10 largest bank holding companies that are active in repo markets. We're focusing on repo markets because that's the largest funding market for which central bank deposits are used to provide liquidity. The red segment just above it are the balances of the next 90 largest banks. And the green segment above that is everything else. There are thousands of banks in the US financial system. We're not even going to use the data in the green. We're focusing on the blue and the red. But of course, the Fed determines the total, and then banks split it up among themselves. As you can see, the Fed's balance sheet normalization reversed in September 2019, going back up again. And that was because there was a big problem in mid-September 2019, when it became apparent that there was not enough reserves to run the US financial system in a way that I'll describe in more detail. And then when COVID hit, of course, the reserves went up and kept going up because the Fed bought an enormous amount of assets in order to deal with the COVID pandemic. And that was only initially for a few days because of an inadequacy of reserve balances. After the first few days of the Fed's purchases, all of the rest was unnecessary as far as having enough reserves. It was a matter of improving market functionality and then eventually quantitative easing. And as a byproduct, it created a lot more reserves than were necessary to run the financial system. And we'll see the implications of that. There were no more problems after that with funding markets and intraday liquidity because there were just tons of reserve balances. And at the end of this talk, one of the options we'll discuss is, well, why not do that all the time? Why not have tons and tons of reserve balances? Well, there are other alternatives, such as the Fed standing repo facility that are alternatives. And we're going to discuss the costs and benefits of those. So what's the evidence? How do we know there wasn't enough balances in the system during the balance sheet normalization period, particularly in September 2019, when this big spike occurred here? Well, we know it because if you look at the vertical axis on this chart, it measures the spread between overnight Treasury-backed repurchase agreements and the interest rate that the Fed offered on balances. Now, as an investment, those are equivalent. They're both risk-free overnight investments. So in perfectly functioning markets, that spread should be zero. Now, of course, nothing is perfect, and we expect little wiggles around zero because arbitrage is not perfect. But you can see there are occasionally spikes in that difference. And if you have really good eyesight or you wait for the regressions, you can see there's also a general secular movement in that spread higher as reserve balances went lower. And the Fed was actually aiming to make this part of the response work. It really wanted to create a little bit of tension and have a shadow price basically for sufficiency of reserves as part of its monetary policy and reserve balance sheet normalization. But I'm claiming it had not intended to cause these big spikes. By the way, we truncated these spikes at 200 basis points so that you could see all the spikes. But this particular spike went to over 300 basis points in the general repo market, which is indexed by SOFR, the secured overnight financing rate. And it went to over 800 basis points in the interdealer repo market. So it was a very severe spike, and it was headlined in all the financial press, and it caused the Fed some degree of stress. The Fed responded very quickly. Repo rates came back down, but as I'll mention a little bit later, they didn't come down enough. Pardon me, they came down too much in the sense that there was another spike when the COVID hit. Once COVID hit, as I mentioned, the reserve balances were increased dramatically and there were no more issues. Let me go into that in a little bit more detail. Here's the big spike in September 2019. In red is the same spread between the secured overnight financing rate and the deposit rate on reserves. And in blue, you can see the balances of these 10 largest repo active dealer banks. And you can see that despite the fact that the Fed actually did increase balances after the September 2019 spike, the balances of the largest repo active dealer banks did not actually increase that much. They were relatively similar at the beginning of March 2020 as they were at the beginning of September 2019. So my own personal view is the Fed, rather than simply watching the total amount of reserves in the system, probably would have done better to watch the amount of reserves that were available to, or at least used by, the 10 largest repo active dealer banks because they're intermediating the repo market. You can see, if you look carefully, the spikes that occurred in March 2020 when the COVID pandemic hit. The Fed was able to cure that problem of market misfunction simply by adding reserves. And after it did, and the reserve balances of the largest dealers, as you can see, went way up, the spread between repo and interest on excess reserves basically disappeared and stayed as tame as a pussycat and remains very, very tame to this point. So this is our window into the fact that it does take a lot of reserves to run the financial system these days, because when reserves get as low as about 1.4 trillion or so, these distortions in overnight repo markets start to happen. Now, sometimes I've gotten comments saying, why do we care? Well, we care a lot in terms of monetary policy transmission. We want that transmission to be relatively steady and predictable. and to integrate into money markets. Well, we also care about the secured overnight financing rate. It's the new main benchmark for US money markets. And we also care about the other criteria that guide how much reserves is enough. And the other criteria include the speed with which banks are paying each other inside each day, intraday payments. And I'll show you in a few moments the impact of not having enough balances on intraday payments. And there's evidence, lots of evidence I will show you, that when you get reserves down towards these lower levels, intraday payment liquidity goes down. Before I get too much further, let me just summarize our main findings in case we run out of time. And by the way, Adrien, how much more time should I plan to use?
So you have 32 more minutes.
Okay, terrific. I'm going to try to finish a little bit earlier because I'm actually more interested in what your panelists have to say than what I have to say, or I already know what I want to say. So the first conclusion that we reached is that funding market liquidity depends on a lot on the ampleness of reserve balances. You saw that in those repo charts. This was already apparent in a previous paper by Correa, Du, and Liao at the Federal Reserve Board. But we're buttressing the fact that funding market liquidity, meaning reserve and foreign exchange in their case, market liquidity depends a lot on having enough reserves. We're focusing on the reserve balances of the 10 largest repo active dealer banks. It's their reserve balances that we find are most critical for determining whether funding markets are liquid and there is sufficient balances to run the intraday payment system. But the balances of the other banks also matter a lot. And why is that? Well, when the other banks have low opening balances, they pay the largest repo banks late. And that in turn leads to repo rate distortions. In fact, if you had to pick one explanatory variable for disruption in repo markets, it's the lateness with which these other banks are paying the large active repo banks. Let me repeat that, it's critical. If you had to pick one indicator signaling when you're expecting to have funding stress on a given day, it's the lateness with which other banks are paying the largest repo active dealer banks. And why would that be? Well, I see Wen Hao is here today. I'm going to pick on him. If Wen Hao is running the repo desk at JP Morgan, he's going to get a call from his global treasury desk saying, be a little bit cautious about lending our money today because it looks like we're going to be receiving our balances from the other banks later than normal, and we sure don't want to run low on our balances. So yeah, make markets in repos, but be sure you get well compensated and don't lend too much because it looks like we may have low balances today. That's basically the story of this paper. Now, there's some interesting side stories, actually very interesting side stories. One of which is, when do we expect JP Morgan to run lower on balances during the day? Well, when they have to pay for a lot of treasuries they just bought in an auction. And indeed, on auction settlement days, which are a day or two after the auction, these banks have to pay tens, often over $100 billion to the Treasury Department, and those balances get extinguished from the system. They are removed from the reserves system. They go into the Treasury's general account. Now that's critical simply because balances are now lower, putting more stress on the system. It's also critical because the Treasury Department requires that it be paid first thing in the morning. And so when Wen Hao has to pay out all of that money first thing in the morning out of his reserve balances accounts, that means he has less flexibility to manage his intraday payment timing and less balances overall to begin with. And on top of all of that, these treasury securities that Wenhow's firm just bought have to be financed. So that can put additional stress on repo markets, because on the demand side, there's now more demand for funding as these very liquid notes circulate heavily in the repo markets. Less time I'm going to have to spend on the other key determinants, but I will bring them up. There's an issue of quarter-end capital requirements. That's the one point in our discussion where it's not intraday balance liquidity that counts in terms of having enough balances to meet your requirements. It's the fact that when you provide more funding, you're using up more balance sheet space, and on quarter ends, foreign banks are affected by that. And that means that they pull out of the market. All of the load now must be borne by the large US dealer banks, or most of the load. And now they have more funding demands on them at the end of a quarter. And that also elevates rates quite a bit, actually, between 10 and 15 basis points. And then also Treasury bill supply matters a lot. And I won't have time to get into that, but maybe we can cover it in discussion. So what did Jamie Dimon say? This is a very important anecdote. It's only anecdotal, but I think it's very revealing. So after that September 2019 blow up in repo markets, JP Morgan had an earnings call for its third quarter, and one of the smarter analysts from Evercore asked Jamie Dimon, who was on the call, "Hey, Jamie, why didn't you invest those reserve balances that you had into the repo market? There were the giant spikes that gave you a lot of profit had you arbitraged those high rates, and yet your balances just sat in your account." And this is different, the analyst asked Jamie, from what JP Morgan did the previous year when spikes occurred. JP Morgan actually did use its balances to arbitrage those spikes. So what was different in 2019? And Jamie Dimon responded, as you can see in the quote at the bottom of the screen, by saying, "We have a checking account at the Fed." And here he's referring to the deposit account of JP Morgan at the Fed, with a certain amount of cash in it. Last year, 2018, we had more cash than we needed for regulatory requirements. So when repo rates went up, that was 2018, we went from the checking account, which was paying IOER, into repo. Obviously makes sense. You make more money. So that's the arbitrage. But now, says Jamie Dimon, the cash in the account, which is still huge, it's 120 billion in the morning and goes down to 60 billion during the course of the day and back to 120 billion at the end of the day. That cash, we believe, is required under resolution and recovery and liquidity stress testing. So I'm going to unpack these regulatory requirements in a moment, but basically Jamie Dimon is saying it's not so much a question of how much we have in the account in total, it's how much we have in excess of what we think we may need to meet regulatory liquidity requirements. And these are intraday liquidity requirements. It's not LCR, which is a 30-day requirement, or NSFR, which is a longer maturity requirement. This is intraday liquidity. So what are these regulatory requirements that prevented JP Morgan from using its huge stock of balances to invest in the repo market when there were apparent arbitrage opportunities? Well, here are the three main categories of regulatory requirements that impinge on intraday, that is in the middle of a day, liquidity that's required of the largest banks. The first one is called CLAR, and that's the sister test to CCAR, if you know what the regulatory capital requirement test is. And in 2019, the large institutions supervisory team was focusing heavily on the ability of banks to pass these intraday liquidity tests. Second is a Federal Reserve Board regulation called Reg YY. And if you read the details in that reg, you'll see that it does cover in detail the need for largest banks to meet intraday liquidity exposures in all foreseeable or plausible scenarios. And then finally, the third item, which has to do with the Dodd-Frank Act requirement that banks are able to be resolved if they run into trouble. And in those resolution requirements, the banks are required to show that if they have to become administratively resolved through a restructuring of their liabilities run by the government, in other words, they go through a failure, in the course of that failure, they need to have enough liquidity, intraday balances, to meet all foreseeable requirements. And you can see that those requirements include things like daily contractual mismatches between inflows and outflows, and daily flows and the movement of cash and collateral for all requirements, including the effect of stress liquidity flows associated with trapped liquidity, and so on. So all three of these buckets of regulation were affecting JP Morgan and all the other large banks in terms of how much balances they felt they should have, not only in the sense of the letter of the rules, but also in the sense that they didn't want to upset their supervisory regulators from the Fed. They didn't want those supervisors coming by and saying, gosh, you were running pretty close to the line there, or you even went over the line. And they also did not want any publicity or loss of reputation for having triggered any fault lines on any of these test requirements. So basically, they became extremely conservative. Now, this takes us to a somewhat different policy issue, which Charles Goodhart, formerly of the Bank of England, once described as the last taxi at the taxi stand rule. And just for those of you that remember Charles' famous metaphor, the passenger comes out of the railway station, goes to the taxi stand to get a ride home, and there's only one taxi at the taxi stand. The taxi driver tells the passenger, I'm sorry, I can't take you because the rule is we always have to have at least one taxi left at the stand. We're not allowed to use it in case somebody comes along. And the passenger says, well, I have come along, I need a ride. And the taxi driver says, well, never mind, there is a rule. We're not allowed to run the available taxis down to zero. And you can see where the metaphor applies here. These banks, even on a very stressful day in September 2019, were making sure that they had plenty of reserves left on their own balance sheets and were prevented thereby from using those balances to meet the needs of market participants who wanted more liquidity. And so repo rates soared. This slide is merely meant to indicate that the volumes in the Treasury market, whether on a stress day or otherwise, are generally very high early in the morning. So most of the action that sets rates happens early in the morning, and that means that the tone of the market, including rates, is set first thing in the morning, which means that when, let's say, Wen Hao on the repo trading desk gets news that he should be very conservative with his balances today, that means that even though the market is not that active later in the day, it's later in the day that the bank has to predict whether its balances will go down a lot or not. So if you're conservative, then you're going to be extra tight on liquidity early in the morning because you don't know whether later in the day that you're going to regret having used up those balances. And indeed, this chart will explain the impact of that on repo rate spreads. And I'm going to take extra time to unpack this chart. On the horizontal axis is the repo market spread, not the spread that I showed you earlier, which is the average across the day for the whole market called SOFR, but rather because we are able to get intraday repo transaction data from Tradition, one of the large brokers, we can look at the spread first thing in the morning in the first 20 minutes, which is plotted along the horizontal axis. So this is the repo rate early in the day when the market tone and the basic rates for the day are actually being effectively set. And you can see that I plotted it here on a log scale so that you can visualize better the giant spikes that are occurring over on the right-hand side up towards 256 basis points. And what is the key variable that is related to that repo rate spread? That's on the vertical axis. It's measured in minutes, and these are minutes later than normal at which the largest 10 active dealer banks are getting paid half of their incoming balances that day. So for example, if the 10 largest repo active dealer banks are getting incoming of $2 trillion that day, which is, by the way, not an unusual amount, 100 minutes late means that they got 1 trillion of that, half of it, 100 minutes later than they normally would, which is normalized to 0. And once that 100-minute sort of excess appears, you start to get these spikes in repo rates up here. This is the big spike that I mentioned earlier. Most of these spikes are over here. So that kind of tells you, if you really want to know whether it's going to be a stressful day and you're predicting early in the morning whether you should charge a high repo rate or not, Wan Hao is going to be getting instruction either based on his own sources or from his global treasuries office saying, we're expecting our incoming payments to be late today, so don't give up money cheap. If you're going to give up any money, make sure that you're getting well compensated. Why are the other banks paying late? Here are the other bank balances on the horizontal axis in billions of dollars. And here is that same variable describing how much later they're paying the large 10 repo active dealer banks. You can see a very tight relationship here. The scatter plot shows that when other bank balances get down below $1 trillion, you're going to see much later than normal incoming payments to the 10 large active dealer banks. The R squared for this relationship is 0.69. And this dot here is September the 17th, 2019. This is when the repo market really blew up. By the way, this dot here, which is equally high, is March 17th, 2020, on the big hit in the COVID market. Actually, the narrative of what happened in the COVID crunch in the repo market seems to emphasize that there was just basically a loss of market functionality, and that had markets been functioning well, you wouldn't have had this problem. That may be partly right, but our numbers seem to indicate that there just wasn't enough balances in the system, which is a much easier problem to cure. So now let's get briefly into the some more traditional kind of regression analysis. I'm going to start with the variable that I mentioned first, which is the dealer opening balances. These are the total amount of reserve balances of the 10 large repo active dealer banks. And you can see that as those balances go down, the spread between SOFR and IOR goes up, and it's a very statistically significant relationship. I'm going to mention also that quarter end matters, because at quarter end, as I pointed out earlier, the foreign banks pull out of the repo market by and large. That means there's extra stress on liquidity provision for US banks. And you get about a 14 basis point elevation just from that fixed effect. That's not the main story of our paper, because we're not mainly interested in the impact of regulatory capital requirements. But if you want to get a good explanation of the data, you should be correcting for that quarter end effect. And here is the most powerful variable, as I mentioned earlier. It's the effect of changing the median time at which the 10 large active repo banks are receiving half of their incoming balances. And that creates an R squared once you correct for quarter end effects of 36%, which is quite important. Now, I won't have time to show you every column in the data, but I want to focus on the 7th regression specification, and in particular go to the last row, coupon issuance. So this is the amount of coupon treasuries issued by the Treasury Department on that day. And you can see that this has a very big effect on the spread between SOFR and IOR for the several reasons that I mentioned earlier. And let me just repeat them. First, when the Treasury gets paid, the money comes out of reserves. So the whole amount of reserves go down. So when you have a lot of Treasury issuance, which can easily be over $100 billion on a given day, that brings reserve balances down, and we know what that does. Second, as I mentioned, the Treasury Department demands to be paid first thing in the morning. So that not only removes reserve balances, it also removes the flexibility of when to pay, which other payment commitments generally have. So that lost American option on when to pay those balances is impinging on the dealers, and they're going to be more conservative when they know it's a Treasury issuance because their balances are low from the very beginning of the day. Some of these other effects are pretty important, like bill issuance and some of these other variables. But as I said, I'm going to come back to that if we have time in the Q&A. The main story, I think you've already gotten, but I want to focus on the spikes in the last few minutes and then finish with a description of some of the alternative policy approaches that a central bank like the Fed can take in this situation. So what about these spikes? So far, I've been emphasizing in regression relationships, the average roll. And by the way, the average roll also is even stronger if you take out the spikes from the data, which we tried. But when you leave the spikes in, effect, although noisier, is bigger in magnitude. If you just focus on the incidence of spikes, we used a probit model to understand which variables are causing the spikes. And we defined a spike. It's a complicated recipe, but basically it's whenever any of the key repo indices are at least 30 basis points above normal. You can read the fine print in the paper. Okay, so let's start by focusing on the 4 key variables that we believe are affecting those spikes. The median time of receives, which I've already motivated, the opening balances of the 10 large dealers, coupon issuance of Treasury securities, and the quarter end effect. And let's first start by turning all of these variables to normal. So no quarter end, coupon issuance is at the average level of $10 billion. Opening balances are at the average level during our sample period of 686 billion. And it's a normal day in terms of when the large banks are getting paid their incoming payments. That's associated with a predicted likelihood of a spike of about 1%. So what I'm going to do now is toggle on and toggle off some of these key explanatory variables. The first thing I'm going to toggle is the time at which the largest banks get paid half of their incoming payments. A 1 standard deviation change is 58 minutes. When you toggle that to a late incoming payment day, the probability of a spike doubles to about 2%. The next thing I'm going to do is toggle in a lower opening balances for the 10 largest repo active banks. And that doubles again the likelihood of a spike to about 4%. The next thing I can do is turn off the opening balance effect and return opening balances to normal. Turn off the median receive time, so it's a normal incoming payment day, but turn on the Treasury issuance and increase Treasury issuance by 1 standard deviation in our sample period to $91 billion. In that case, you again get about a 4% likelihood of a spike. Now I'm going to turn on all 3 of these. It's a late incoming payments day, that's bad news. It's a low initial balances day, that's bad news. and the Treasury is issuing one standard deviation more than normal of Treasury securities. Now the likelihood of a spike is estimated at 11%. If we turn on the quarter end effects, and that means the foreign banks are not providing liquidity to funding markets anymore, these probabilities of a spike go way up. So the last slide before our discussion, what should the Fed do in light of what it's learned about the high amount of reserve balances that seem to be necessary to run the financial system in light of the need for banks to make payments in a timely manner and in light of funding market liquidity, meaning the central bank certainly wants the largest repo active dealer banks to provide repo markets that are reasonably liquid, where the interest rate reflects something like the true value of overnight money, rather than some sort, well, it did represent, the spikes did represent the true value of money, but there was this big shadow price in there for meeting intraday liquidity requirements. So what should the Fed do? And as I said, these are rather consequential decisions. This is not about plumbing. It's really about the financial stability, meaning you don't want balances so low that everybody hoards cash, waiting for everybody else to pay them, causing a self-fulfilling expectation of a liquidity crunch. In fact, one of our co-authors, David Elin Yang, is writing his job market paper on exactly that. And Adrien Quentin have another paper on exactly that issue. And you want liquid markets in part because when the Fed raises or lowers rates, it wants market rates to reflect the Fed's desired target level for rates and not some random spike that incorporates the disruption associated with insufficient balances. Okay, so what are the options? One is, well, do what the Fed eventually did anyway because of the COVID pandemic, just have an obviously clearly abundant amount of reserve balances. I think the Fed had always intended that there should be an ample level of reserve balances, but it just wasn't easy to guess. And rather than leaving it to guesswork, just flood the market with reserves. Well, I see Bill Nelson is here today. He's pointed out in one of his papers that impinges on bank capital requirements. There's a thing called the supplementary leverage ratio rule, which means that when the Fed is generating enormous amounts of reserves for banks to hold, that's stuffing the banks with assets. And even though reserves are completely free of any risk, by definition, the central bank determines what a dollar is. There's no risk in central bank deposits in the United States. Nevertheless, their capital requirements are requiring banks to increase equity when they have more reserves. And that, because of debt overhang effects, the banks don't really want to do. And so you get crowding out effect. Another possibility, if you increase balances enough, is that actually Bill has written about this one as well, as have others. If rates were to lift off zero, which may happen someday, the way things are going, then the Fed is going to end up paying the largest banks a lot of interest on those huge balances. And right now, the amount of reserves in the system is approaching 4 trillion, or it's around maybe a bit more than $4 trillion now. If you multiply $4 trillion by 1% or 2% of interest rate, and it could go higher, that's a substantial amount of money. Now, that's not necessarily economically damaging, but it doesn't have a great look for the Fed to be paying the largest banks huge amounts of interest payments, and it could cause some consternation in the news.
Hey, Darrell, I'm sorry to interrupt. So if you want to have some Q&A time, I think we are like about 6 minutes left.
Okay, then I'm just going to stop, but let me just mention the other opportunities: standing repo facility, which the Fed has already done. Relax these liquidity rules so that you get rid of the Charles Goodhart problem and you're able to use the liquidity when you need it. And then another point that Bill Nelson has mentioned, which is to try to get the banks to use the discount window or to draw on daylight overdrafts, which the banks are reluctant to do because of the stigma effect. So I didn't realize I was running so late. I'm sorry about that, Adrien.
No worries. Thanks a lot for your presentation. So we can take a few questions. You can either write them on the chat or raise your hand. I think Per Stromweg has a first question where he's wondering if there's any evidence of broader effects beyond interbank markets of this rate spike on other part of the financial system. And then Marco Machiavelli is wondering whether the small effect of bill issuance relative to the coupon issuance is due to the fact that dealers take more time to offload longer dated bonds and so need to finance them in the repo market to a greater extent.
Okay, so let me address the first one first. There's a lot packed into those two questions. So broader effects. Well, one effect is transparency. So back in September 2019, I don't think people had actually sorted out what was causing these huge spikes in repo markets, and people were very concerned that maybe the financial system was unraveling and that something very, very bad was happening. And really, it was just that there wasn't enough reserves. Had there been enough reserves, you would have seen that repo markets would have been tamed, but market participants had a hard time figuring that out. So market transparency is impaired when you get a lot of noise. Financial stability can be impaired because, as David Elin Yang shows in his job market paper, if this gets bad enough, then everybody's going to hold up paying anybody until they get paid, which is a self-fulfilling crunch. And that obviously has very, very broad financial stability implications. And then, as I mentioned, monetary policy transmission, which is a very broad effect, matters a lot. And if your main policy targeting is not working because it's not getting into the largest and most important funding markets in the economy, then that's also a general economic problem because the Fed's monetary policy is a general economic issue. And then Marco's question, we think the difference between bill issuance and coupon issuance is the fact that the coupon issuances are heavily refinanced in the repo market, and the bills are generally not heavily circulated in the repo market. And so that's putting extra demands on repo rates. Is the coupon issuance mechanically pushing down reserves? Yes, it's a one-for-one mechanical relationship. Whenever you issue any treasury security for $100 billion, there's a $100 billion automatic reduction in the amount of reserves first thing in the morning. So I don't know if that's sufficient, but let's move on if there's any more time.
Quentin, you want to go on?
Yes, thank you. So we are definitely on the very same page when it comes to explanation of what happens, but there's still something that's very puzzling to me, which is that after September, the Fed increased the reserve supply by something like 200 to 300 billion. And this, for whatever reason, did not end up in the balance sheet of the securities dealer banks. And I'm wondering, so there seems to be a friction there because that's where the reserves would have been useful. And I'm wondering if you have some planche explanation for that.
Yeah, I do. So there was actually over 500 billion that the Fed added after the September 2019 crunch, but most of it did not, as you pointed out, end up on the balance sheets of the largest 10 repo active dealer banks. They don't actually lose money when these rate spikes occur. They can, to some extent, make money because reserves are scarcer. So that doesn't bother them so much. And at that point, interest rates were very, very low. So the advantage of holding reserves was much lower than it had been. And then finally, there are regulatory capital requirements associated with the SLR. And when reserve balances go way up, it doesn't necessarily mean that the largest banks want to hold them. They didn't really have any choice after March 2020 because the Fed has now purchased over, I think it's around 5 trillion or so of assets. And so those are going to end up with the largest banks no matter what. They don't have a choice.
All right, let me shoot one last question then. So on the what to do, it is still another possibility, which is not do anything. It seems that there was a surprise shock and the question was left open about how much reserve necessary for a smooth plumbing. But now that we've learned about some friction that can be internalized, maybe market participants will adjust their leverage and their friction need, and then maybe the Fed does not need to add more reserve or other facilities, and the market participant will adjust themselves, such as these repo spikes will disappear.
Yeah, that's actually one of the most common suggestions that I've received is just let the banks work it out. And I think that they would eventually get better and better at handling lower levels of reserves, get more active, put up more desks that would trade repo whenever the opportunity arose. But basically, we saw that movie already in the first episode of that movie was called Fed balance sheet normalization. The Fed was doing exactly what you suggested. It was lowering reserves on a very predictable, smooth glide path, and banks were gradually learning over time, and they had plenty of time to do that, how to manage their reserves better and how to enter the market for repos. But we still had a huge disruption in September 2019, and that was only one of many spikes in repo rates. So I think, yeah, the system could manage eventually, but do you really want to incur the financial stability, monetary policy transmission, funding market squeezes, intraday liquidity squeezes, as you teach the market how to do that? And I would say the trade-offs suggest one of the other policy solutions. But the alternative you just mentioned has been emphasized to me by many, including actually one or two people that are here present today. And so I'm respectful of that point of view, but I happen to disagree with it.
Well, thank you very much for your speech. We will now have a 2-minute break and have our second guest speaker, Dimon Rousseau. Thank you, everyone.
Thank you, Darrell. Great presentation. Can I ask one quick question? It seems that the problem is about intraday sequence of payment. Why doesn't the Treasury Department wait until the market's clear? Because it seems it's just an intraday issue, right? If they wait, then the problems are solved.
Okay, so, well, that's a great question. I actually called the people in the debt management office that are responsible for this, and they didn't want to engage on that particular question. But if I had to introspect based on conversations with others, I would say it's counterparty risk. The Treasury Department is in a position where it can command that they could be paid early in the morning. And if it decides not to do that, then it incurs the small amount of risk that someone won't pay it during the day. And that would not be a good look in terms of the debt management office. Somebody would write a headline saying, the Treasury Department waited till the end of the day, didn't get paid. Now it has to issue more Treasury securities. This is disruptive, et cetera, et cetera. So I think the Treasury just wants to make sure it gets the first chance to dip into the pool of reserves that are available early in the day.
Thank you.
Great question, Wenhao. Nice book collection.
All right, excellent. So now we have our second guest, is Dimon Rousseau. Dimon is Director General Market Operation at the European Central Bank since January 2020. And before that, Director of Markets at the Banque de France. With a credential as central banker and experience during the COVID crisis, I think there are few people more qualified to talk about money markets at the crossroads. Again, at the end of the talk, we'll have a 10-minute Q&A, and you're welcome to write any question or raise your hand during that period. Dimon, the floor is yours.